other stuff. Okay, cool. Let's talk portfolios then. So it's the start of Q4, and that means that all the kind of high-powered investors have just been sending in their 13Fs while we wait for ours to appear. We thought we'd have a look at what's going on with the portfolios that we kind of run and manage, I guess, for basically ourselves. So, Steve, what's been going on at the kind of top end of your portfolio? What does that look like at the moment?
So for me, I think there'll be no surprises. So maybe one surprise in the top three of mine. So my top three at the moment is Amazon, it's Alphabet, and it's Netflix, in that order. And it's been jumping around a bit, just mainly because I've averaged down quite heavily on my Netflix position. I was a little bit early on that when I jumped the gun. I Ackman'd, if you will. And I've been constantly adding to that position now. At one point, I was about £2,600 down on it, which is quite a significant amount of money because it's, my position is about $5,000, so I was about 50% down on it. FX has come to the rescue a little bit, and obviously Netflix has been creeping up over the last at least sort of 6 weeks or so. So that's got to the point now where I'm only about £600 down on it, and it's looking like a pretty nice little position. The problem is that it's vastly oversized how much I originally wanted it to be. But I am still very bullish on Netflix. I don't think I need to go over Amazon and Alphabet because I think we talk about them a lot and why we're bullish about them. But with Netflix, I'm still very bullish on their ad campaign that's coming up, their ad-supported content. And I was listening to the Streetwise podcast today. I don't know if you've heard that one with Jack and Jackson. And they were talking about Netflix's ad load. And this is per content hour when this ad-supported model comes out, how much they think they're going to be advertising per content hour of Netflix content. And apparently they're only looking for 4 minutes. And when you think about watching on TV, I mean, TV is the advertising is just awful, isn't it? I mean, it's every 15 minutes you get a 5-minute break. So I think 4 minutes over an hour is pretty good. And the reason I think that's good as a shareholder as well is that it's going to be a little introduction into advertising for people, but they always crank that up over time, and that's a way of cranking their revenue up over time as well. Apparently, they're asking for an average $65 per milli, so that's their impression ratio, which is incredible if they can get it. Jack Howe was saying that the average rate on TV at the moment is about $45 per milli, and it's even less than that if you're in the scatter market. So that's interesting. I think they can drive the price up a little bit because there's only going to be 4 minutes of 4 minutes of ad load per content hour, so there's going to be a scarcity of product there. And in the same way that people really do fight to get in front of when the Super Bowl's on or an advertising of something of that kind of nature, I bet you there'll be a little fight to get in on Stranger Things on day one when that first new season comes out. So Netflix might be able to achieve this, Steve.
Yeah, look, I mean, we've talked up Netflix and its kind of proposition of having certain numbers of viewers and subscribers and so on in some fairly decent detail, I think, over a few podcasts. We had at one stage, every time Netflix had an earnings review, we talked about that and its number of subscribers, and we had a quarterly, here's what we've been watching on Netflix. But I think a couple of things for your portfolio specifically, I guess. You mentioned it's kind of bigger than you intended it to be. It's now the third biggest thing in your portfolio behind Amazon and Alphabet, I think you said in that order. There's worse things in the world, and you know this as well as I do, than having a stock that's doing really well taking up quite a lot of your portfolio one way or another, because as we were talking about the other day, Netflix is actually a stock that's done pretty well in all of this stuff. I mean, its last couple of earnings calls have not been positive. It's been losing subscribers and forecasting to lose them kind of further ahead. But it did look like, if you like kind of thinking about stock price movements, a stock that had got itself into a situation where it didn't need that much to either go right or stop going wrong for it to launch quite a decent recovery. So you kind of saw your way into that and then didn't go the full Ackman and then sell it again 2 minutes later because you decided it was basically a bust. The stuff on the advertising is really interesting because one of the kind of question marks I had after the last one was exactly what's the kind of model going to look like here? Is it going to be the kind of thing where we have an ad-supported tier that is what I would call Spotify style, so prohibitively bad, and we try and funnel everybody into the paid tier by offering them something terrible for free, but something that could be so much better if you would only give us 15 quid a month or something? Or is it going to be a kind of thing, if you have that, that's not a particularly attractive, as far as I can tell, proposition for advertisers, because everyone's going to run off that tier and they're not going to see the ads? Or is it going to be a kind of good thing for an advertiser, but with less of an incentive for people to kind of upgrade? And the way you're kind of talking about that to me makes it sound like it's the second one. It's going to be quite an attractive thing for Netflix ad-funded subscribers, if we call them that for the time being. And that's going to make an attractive package for advertisers, and trying to charge quite a premium there, which you might well get given their kind of position in this market, I guess.
And that's it, isn't it? I think I was looking at some data just on their financial releases the other day, and we're talking about like things they've come up against recently in terms of like engagement of watchers. Stranger Things, just their most recent series, has done 7 times the viewing hours of Top Gun, and it's done double the viewing hours of Obi-Wan Kenobi, this series on Disney Plus. So they've got some really, really good content. They've got some crap. Like, everybody will tell you they've got some crap, but they have got some really good content in there as well. And if they're going to allow advertisers to sort of pick and choose what content they want to be associated with, which is what you would assume they would want them to do, I think that's a really attractive proposition. And the fact that they can slowly crank up the 4 minutes to 5 minutes to 8 minutes to 10 minutes per hour. I mean, I wouldn't want to be on the ad-supported tier. I'm happy to pay to not be on the ad-supported tier. But as an investor looking on from the outside, I mean, if you can't see a clear path to growth for Netflix, especially when they're starting with, I think this is the best case way of introducing advertisements for them. So they're introducing this best case advertising scenario. This is only going to generate more revenue for them. So I think it's all looks good from here. In terms of my position, though, which was the original point, I probably will cut this position at some point in the next year. Not cut it entirely, but I will. I probably wouldn't even right size it, but I would look to trim it down a little bit, because as much as I am bullish on Netflix, I wouldn't say it's in my top 3 ideas. I wouldn't say it's outside of Alphabet. I wouldn't say it's outside of Amazon. I wouldn't say it's outside of ASML. I don't think it's too much further below that point, but do I want to bet my house on it? No.
So I guess the question then becomes, I take that point, and as it is, one thing I note about your top 3, and I don't have a problem with this at all for what it's worth, is it's heavily exposed to advertising, and it's heavily big cap US. And that's fine. You can be absolutely bullish advertising if you like, and if you are, it makes sense to have those 3 things as the top 3. So your plan is to try and cut down Netflix then, rather than just grow the other stuff around the side of it, as it were, and leave it where it is and stick money into ASML to push ASML up past it again. I don't know quite how much of it is which in your portfolio, whether that's viable or not, but you get the idea.
Yeah, well, the issue with buying a lot more of the other stocks around it at the moment is they're also US stocks, and you feel like you're getting a bit of a raw deal at the moment, especially when you can look at the UK market, as we said last week, and so there's quite a lot of stocks in there that we think is good value and that we think we perhaps should start building positions in. I mean, we're talking Rightmove here, is one that we both like and both have started entering a position in. I've been looking at Haleon recently, which actually has a surprising list of very good brands, and I would quite like to continue building a position in that. But there's just a few stocks dotted around at the moment, even in the EU, where the euro has had some issues against the dollar as well. There's stocks across there that I really like. We're talking about all the Swiss stocks, but there's still Adidas. There's Alstom, which I've been building a position in. There's BioMaru that we talked about last week. There's ASM International in Holland, which is another really good company. And I mean, one of the companies I did buy was ASML. I bought some more ASML in the last 2 weeks as well when that was down. And that's so far been timed quite well, because it's shot straight back up. So there are plenty of opportunities back home at the moment. I'm still trying to shrug off that dollar issue. I guess over the long term, we would say to ourselves, if we were looking at ourselves, don't worry, it'll all even itself out. But right here, right now, in the moment, it just doesn't feel like the right time to be going and splashing a lot of money in the US.
Yeah, I'm not sure. I don't really have a view on whether these things even out over the long term for what it's worth. I mean, I think certainly within our lifetimes, people might run kind of different monetary policies. I mean, the US is taking a different direction to the UK, and I think the directions that they are going in could well determine their situation relative to one another for certainly a few decades in this kind of case. The US is roughly doing what the kind of on paper right thing to do is, which is raise interest rates, try and get strength back into the dollar, and deal with the likelihood of a recession that will come as a result of it. And the UK has decided it's taken the other way, which is try and fend off the recession by borrowing, I guess they'll say, one more time, now that we've got a government and that's got its own ideas and so on, and try and grow the economy to repay that debt. Which one's the right one? Well, the kind of conventional wisdom says the US. Conventional wisdom can be wrong about plenty of things. I'm not particularly taking a view on it. I talked about the budget last week. We don't need to hear me talk about that again. But it's really interesting, though, to watch those two going in different directions.
It is, isn't it? I guess the issue we have in the they've got a little bit in the Americas as well, is that the Treasury keeps spending while the Fed is trying to cut and sort out the balance sheet. Over here, we have a problem where the Bank of England was trying to sort out its balance sheet and trying to raise interest rates, and the government went on a wild spending spree. And I think that's the difference between the two. But Steve, go on. What's your top stocks?
Yeah, okay, so I'll tell you what the top end of my portfolio looks like a little bit, but just to go back a quarter then for the moment, when I wrote down my stuff at the end of Q3, my top, let's say, 4 for the moment were Berkshire Hathaway B shares, Amazon, Citigroup, and Alphabet. So none of those is in my top 2 anymore. They've all slid down to positions 3, 4, 5, and 6 now in my portfolio, and I've bought shares in every single one of them in the last quarter. But coming in at the top is 2 is now Apple, which I bought when it came down to about 145 or so. I was buying it around the time of the Queen's funeral, so slightly before the bottom fell out of the pound. And also Federal Realty Investment Trust, which is a REIT that I mentioned as a stock for Paul a while ago. I don't particularly have any kind of deep plans for this. My suspicion is that it won't be at the top of my portfolio in the future, but the yield on that shot up to about 5%, and I thought, well, I'm going to stick a fair bit of cash into this. It's come down a bit since I bought it. That's okay. I don't mind buying more of it. But my idea here is that, well, look, I'm trying to take the long view with my portfolio for the moment. And when I think about what I want this to look in the future, I suspect this will be one of my smaller positions because I intend to kind of invest money into other shares and see opportunities, whatever they may be in the future, that will bring us on and past it. But that now gives me a top 3 that goes Federal Realty Investment, Apple, and Berkshire Hathaway, which I guess leaves me disproportionately exposed to Apple. A little bit, since that's kind of in the middle, and it's by what Buffett calls kind of market size, Berkshire's second biggest business it owns, even though it only owns about 20%. Owns way less than 20% of Apple. Owns less than 10, I think. But that's where I'm at the moment. Amazon, Citi, and Alphabet are chasing on the heels of them, insofar as it's a competition, which it isn't.
It's interesting, and so we talk a lot about the stocks that we buy as well. So we're buying a lot of things for usually for a combined reason, or at least some combined thinking on something. But did you say Amazon is still your biggest?
No, Amazon's now at 4. Federal Realty Investment Trust, my REIT, is biggest. Then it's Apple. Then it's Berkshire.
Are you following Bury?
Not exactly, and I don't think I'm following Bury in the following sense. So I've been seeing REITs coming down quite a bit. I mentioned the other week that I'd had a few notifications go off, and I couldn't really remember why, but they were basically all property-related things. So they were Rightmove or some bunch of REITs, more or less. And I think that's a product of interest rates going up, for what it's worth, because a lot of REITs are kind of debt-funded, because if you distribute all of your earnings, it's quite hard to keep enough back to kind of do anything with. So they rely a lot on bond issuances, they rely a lot on raising debt, or they dilute. and Federal Realty has done both of those things in the past. It doesn't look to me like it's massively levered. I looked at when its debt expirations and the maturities on its bonds are. They don't look like they're coming soon to me, and I don't think there's going to be a problem with this, which meant that I think I see this as something that's kind of got swept up in a bit of an overreaction coming down. It was on my radar for some time because it's a real estate investment trust that I can at least understand the moat on, or at least the kind of idea of a moat. It tries to get hold of the best bits of land in second ring, as they call it. So imagine a city centre and then concentric circles coming out. First and second ring locations, there's only finite amounts of that. People will continue to need to shop in those things. So I liked it a lot, and I saw an opportunity, and I went and I feel like I steadily built out a position in it, to be honest, but I did it all over the last quarter. There wasn't a day where I went, bang, I'm having 100 shares of this, or whatever it was. But I have managed to kind of creep my way up there in the last quarter. And I was slightly surprised it was the biggest thing when I came to write these down a few days ago at the start of the month.
Yeah, it's one of the stocks I don't think me and you have actually spoke to each other about too much, I don't think. Go on.
No, not much. Bearing in mind, I also have a side investment that I don't count in this portfolio. My previously cashed out premium bonds got dumped into Realty Income, and I don't count that as part of my portfolio because it's not, in my view, subject to change. That's a sort of different project that I described about 25 shows ago or something like that. Or in fact, back in January. That's doing very nicely, actually, for what it's worth. But it does mean that, I guess, when you think about my investing in total, quite heavily exposed to retail REITs that we're not supposed to like very much at the moment.
That's true, although they do look very good at the moment. In fact, I think REITs across the board have come down so much that they're looking really, really interesting. And not just in the US either, they're both on our shores as well. I mean, Paul has a rather big holding in Seagra, and I think he's actually Reading, and I asked him the other day if he'd finally gone red. I remember he was up a long way on it, and he said he was down nearly 30%, so and I think he had a good price on that, because I seem to remember him being up 80-90%, and to be down 30%, that shows you how far it's fallen. But we were looking at the Tritax Big Box and the Euro Box as well. That's come down an awful lot. And then across the pond in America, I mean, Prologis has come down from, I think, 180 to 100. And the only ones that seem to kind of be holding the ground are the really big, sort of powerful ones. So things like Equinix, that's been holding its ground pretty well. And things like Digital Realty, though, they're coming down as well. I noticed ISA, investor friend of the show, he's been buying a little bit more of that as well, I think. So interesting time for REITs. Have you got your eyes on any more, or you're not going to Casper your way into REITs?
I'm probably not going to Casper my way into REITs. I did have a nearly notification go off on one that Casper absolutely loves, which is Stag, which is the industrial real estate thing. I think it pays its dividends monthly. I'm not certain about that. I would need to check, so don't quote me on that one. But this is one where I set a notification for stock market stuff ages and ages ago, and then forgot about it. And it got very close to where I had it set. I think I had it set at 27, and I think it got into the higher than that 20s. Can't remember why I put it there, but it very nearly got there. Jim Chanos, I was just Googling who I was thinking of here, who's a noted kind of short seller. His next big short idea is, in fact, data center REITs. He thinks they're still... I mean, you put holding up quite well. He thinks they're still grossly overpriced, from what I can see of it, and thinks that one of the kind of structural issues with REITs, and it's true if you have a bigger price cap, is that kind of debt issue, basically, is debt matures, and the only thing you need debt to kind of service things. I would look carefully at what the kind of debt commitments were on the REITs I own. Indeed, I did look fairly carefully at them, and both Realty Income, I don't currently own Agree Realty, which is yet another retail REIT that I have historically had. That's held up slightly better. But all three of those, I think, have reasonable kind of debt maturities and don't have a load of stuff coming up soon that they'll need to roll at difficult rates, in the style of someone with, say, a UK mortgage. So if they're coming off their fixed period at the moment, there's a lot of talk from what I see both in the Discord and around people I know and just my colleagues and so on, of they're coming off a kind of 2% mortgage and they're looking at something close to a 6% renewal for that, and all of a sudden things look very expensive. Similar sort of story if you're a real estate investment trust, I guess, and you are financing by bonds and you need to reissue them. You're going to roll that at a higher rate and it's going to be expensive.
Yeah, and that's the main consideration, I think, when you're looking at REITs both home and abroad. One of the ways they can counter that is by selling properties, but that's not a great thing. That's not a great thing, and they've got to also, if they do start selling stuff, that's going to count as profit, and they've got to pay that out over a certain period of time as well. So just be really careful, because one of the things you might see is the REIT balance sheet shrinking, but they're shrinking because they're paying off debt by using their properties to do so. So it's just one of the things to keep an eye on in this period of sort of high interest.
Very good example of selling stuff at the wrong time, for what it's worth as well. If you're a property person, you don't want to be selling it at the time. You probably bought it when it was more expensive than it is now, if it's a recent kind of thing. But okay, that's the top end of my portfolio. Anyway, it's got a couple of new entrants at the top, which makes it look exciting, even though I don't feel sort of desperately like I've done really exciting things.